Okay. Good morning, good afternoon, and good evening. It's 6:55 p.m. Thursday, May 11th, and you're tuning in to the latest episode of Mark Yu and Wowie Show. For those who are not aware, this is Mark Yu,
This is Wawi Santos.
and we are healthcare practitioners, basically, but we have a passion and interest in investing our hard-earned money in the stock market. So welcome to today's episode 77, Smooth Sailing. So we're just going to take a look at a quick rundown of some insights provided by FactSet. You can access this in their website. So far for the first quarter, a lot of companies already reported, and according to John Butters, given the weaker US dollar in recent months, our S&P 500 companies with more international revenue exposure reporting higher earnings and revenues for the first quarter 2023 compared to the ones who have more domestic revenue exposure. So he's basically comparing those international companies to local US companies. And are they impacted by weaker US dollar? The basic answer is no. So according to the research that he had provided, for companies that generate more than 50% or more of the half of their business inside the United States, their earnings growth rate is 2.7%. Meanwhile, for companies that generate more than 50% of their sales outside the United States, their earnings decline, get this, by 10%. So international companies are actually earning less because of the weaker dollar. It's kind of in contrast where you might think because of the US dollar weaker, more foreign countries would be buying more US products and take advantage of this, but the answer is not. In fact, it is a lot weaker for international companies. Among the industries, healthcare and information technology are the sectors that are top contributors to the both earnings and revenue declines for the S&P 500 with more international revenue exposure. So if we're going to take a look closer, which of these S&P 500 companies, it's both Intel and Moderna that generate more than 70% of their revenues outside the US. Pfizer generates just under 60% of revenues outside. If these three companies were excluded in the earnings that generate more than 50% outside the United States, this would entail improvement to negative 5.6% from the big drawdown of negative 10%. So the pharma companies, both Moderna and Pfizer and Intel, which help added to the poorer performance in terms of international companies reporting their earnings for the first quarter of this year, 2023. So if you're going to do a quick rundown, utilities, of course, who among the utilities will be providing electricity or water overseas among US companies? So they're the least geographically exposed, followed by real estate, followed by financials. The most exposed internationally is infotech, materials, and communication services, followed by consumer staples. So just factful information there from FactSet. So now we're just going to take a look at the weekly sentiments provided by the American Association of Individual Investors. For this week, we are still down less than 30%. We are at 29.4% bullish compared to 24.1% last week. We are, as we could say, at the highest bullish sentiment in the past 4 weeks. Bearish sentiment, it's still a little bit elevated, 41.2% compared to 44.9% last week. Still elevated for the past month. For the fear and greed index, wow, we're back in the greed territory. From 52 points last week, which was just neutral, we're at 59. A little bit upside there. For the greed market momentum, The one that we're looking for is the S&P 500 versus its 125-day moving average. We are still quite ways above it, 4130 versus 4010. So far this year, we only touch the 125-day moving average once back in March 9th to March 14th. I believe that was when Silicon Valley Bank and Silvergate Bank filed for receivership. FDIC had to take over. So for the volatility for the past 5 days, it's been down, believe it or not, 7.9%, which means not much downtrend on the overall S&P 500. The S&P 500 as a sector is surviving. It's up 1.12% for the past 5 days. Meanwhile, the volatility in the Nasdaq, it's down 10% for past 5 days. Quite a performance, as we're gonna see in a little bit. I think I have a gut feel who among the biggest Nasdaq is responsible for the uptrend, which we're gonna see. So Nasdaq, it's up 2%. So if we're gonna take a look at the big tech stocks, Apple just came out with their earnings last Thursday, which we tackled on a previous episode. Apple for the past 5 days, it's up 1.64%, up to $2 a share. Facebook, it's up Facebook, it's up 1.78%. Netflix, it's up 6.65% for the past 5 days, which is good. Contrastingly, I think Disney has been down on the sucky end of things. Disney is not part of the big tech, but it's down. Oh, just today, it's down 8.7%. It came out with their earnings yesterday, which we're going to take a look in a little bit. But for the past week, it's down 6.5%. And my best hunch or best stock, I believe, so that outperformed so far with the past 5 days, responsible for the upside in Nasdaq, is no other than Google. It's up 11%. It's now closing into a $1.5 trillion valuation again, which we haven't seen during the 2020. Look at that. Google, $116 a share. Whereas for the past 2022, for the past year, during that year, it was as high as $141 a share. So still quite a ways. It's still down 17% from that peak in that year. But I think, did you see their INO event, Huawei, last night when they came out with their new phones and stuff?
No, but I heard of the Fold. you know.
Yes, they
Yeah,
came out with a Pixel Fold. They're no longer ashamed of copying whatever Samsung's coming out. But yep, they came out with a Fold, and they also are bragging that Bard, their own version of ChatGPT, will be included in a Google search. I don't know how that works, but eventually we'll be, we'll be able to take advantage. And right now we're gonna take a look at the 30-year mortgage. Jumping on the next data here that we have on our screen. This is provided by Mortgage News Daily on a daily basis. So we have been trending since the start of the year between 6 and 7%. Nothing less, nothing more than that. So as of today, it's back above 6.49%. So still a little pricey, whereas over a year ago, it's a lot less than that. It was around 5.01% about a year ago. So on we go to our group sector performance. This is provided by Financial Visualizations. For the past 5 days, number one performing sector is the consumer or communication services, which is up 5.8%. And my best guess, it will be Google that's leading this sector outperformance, followed by consumer cyclical, technology, financials. The only worst performing sector is basic materials. I think industrials are not doing so hot recently. And since the start of the year, wow, look at that. Technology up 20%. Communication services 24%. And the worst performing sector was the best performing sector last year. Energy down 7%, followed by financials 1.74% down. I would have imagined that financials would have been the worst performing sector. Would you say so, Awi? As of this time, right?
Yeah, I would say so. Yeah, because of the recent banking crisis.
Right. And they just came out with their quarterly SLOOS report, which is much anticipated by everybody looking at the financial sector as a whole. The Senior Loan Officer Opinion Survey. This just came out yesterday. And we're not going to delve into deep dive right now, but I did pull out some interesting charts. Oh, this was provided by no other than Bank of America Global Research Team. So banks reporting tightening standards for commercial real estate loans. So, as you can see here, we are at hovering as high as when we saw back in COVID lockdown, as high as when we saw the panic, the Great Recession back in 0809, and not as high as that on previous history. So this is quite alarming. And Bank of America was nice enough to dissect the construction, non-farm, and even multifamily residential, which is, those apartment complexes. So not a whole lot of banks are willing to lend at this point of time, which means that we are closing in on a very tight, let's see, spread data.
If we keep seeing that trend, then real estate, both in the housing sector, will be affected as well, not just commercial.
Yes, exactly. If you're going to look at the Chicago Fed National Financial Condition Index, we are definitely heading the down side of things, which just means that well, this is in quite a contrast for Chicago Fed. They said that if it's going down to the negative side, it's actually loosening than average. So we would stop using this Chicago Fed National Index because it's not actually reflecting what's happening right now in the markets. It's the contrast. And it's updated as of May 5th. We've been relying on that for most mid part of our mid-season last year. But right now, it's not reflecting things that are obviously being reflected nowadays. So another chart from Bank of America derived from the recent SLOOS report, Senior Loan Officer report, banks reporting tighter standards for consumer loans. So this involves Bank of America was able to dissect it actually, credit card, auto loans, and other loans. As you may have known, me and while we have been sharing on this podcast or this YouTube video earlier on, that the U.S. market, U.S. economy mainly relies on consumers. So tightening standards in all loans, consumer loans. So this has been an upslope since the Fed decided to hike up rates back in 2021, and it's still everly increasing. Not as high as COVID, of course, and not as high as during the Great Depression, but we already surpassed where we were once back in 01, 02 tech bubble crisis. So something to keep in mind. And this is it. Banks' willingness to make consumer installment loans. So positive values indicate increased willingness to lend to consumers, negative otherwise. So quite alarmingly, we are seeing a sharp decline right now. Willingness of banks for consumer installment loans. These are personal loans. So in a short matter of time since the Fed started hiking rates back in mid 2021, we are seeing a lot of tightness. banks are now being more selective in terms of their loaning standards. So altogether, the net percentages of banks reporting tighter credit standards, increasing loan rates over banks' cost of funds, stronger demand are in line with prior recessionary episodes in the US economy. That said, the data only extend to 1991 and cover a limited set of business cycles. We review tighter banking lending standards as a necessary but not sufficient condition for identifying US recessionary episodes. So it's not a 1:1 data finding according to this research, but definitely the data that we have just shown you guys, which is, based on Bank of America research, is in line with prior recessionary episodes. So if you're going to go back, listen to our previous episodes, we have used the Federal Reserve recession tracker, which forecasts a recession 12 months ahead, and they're seeing it by this time next year. So quite an interesting find, right, Wawi? Or senior loan officers?
Yeah, well, there's definitely strong pressures for a recession right
Yep.
now because of the current rates that's imposed on lending. So with less lending for consumers and companies, then we're gonna be, slowing down more. And when it slows down, that it can fall off a cliff into a recession. That's why there's a lot of people like thinking that the Fed will pause because of all these signals that
Right.
are coming up.
Yep.
But
And
you
there,
never know. You never know because there's still talk of 25 BPS, next, rate hike
true.
cycle.
There is still some potential, but according to the CME Fed Watch tool, they're seeing 92.8% of the surveyors are seeing no rate hikes for June 14th, while there are some a little bit 7% of those ones surveyed sees potential 25 basis point hike. So it's definitely not ruled out yet at this point in time.
That would be good. I'm glad to see that graph go higher because I think that would be a good time for them to just watch
Uh-huh.
and see because they raise it so fast
Yeah,
and the effects
500
is
basis
so
points.
so
Yeah,
strong. Mhm.
in 1 year. Yep. Let's have them watch and see break things. As Jerome Powell would like it. More unemployment. For the fund flows, so this is as of last week. Equity funds globally see biggest weekly outflow in 5 weeks. So a lot of funds coming out. Net nearly 17 billion came out of stock market funds globally. And wonder if we could get some money market information here. Money market, money market, money market. Oh, that's why. Investors continued to favor money market. They still poured $44 billion, higher than 41.7. A lot of money still pouring into the money market funds. A lot of
They're
people
just waiting.
expensive. Yep.
Can you hear me?
Yes, a little bit choppy, but yeah, that's fine.
Okay.
The S&P 500, nonetheless, a lot of experts or financials, hedge funds are betting they are still major short the S&P 500, not seen since 2011 and 2007. So a lot of big money behind buying put options, betting that the market would go down. So we're just going to take a brief look in terms of earnings report this week, or since last time that we recorded, since last Friday. So among them, the biggest companies are Berkshire Hathaway and Toyota Motor group. So for Berkshire, they actually recorded a lot of growth in terms of their numbers. So for their cash, they are at now at $103 billion plus 23.8. That's 24.6. $128 billion in cash plus 22.6 more for fixed. Notwithstanding, they also have more than a third of $1 trillion, $328 billion invested in the stock market. So definitely cash heavy on these guys. And their revenue for their insurance business, it grew from 58.8 billion to 63.45 billion. Their railroad freight activities grew from 11.9 billion to 21.9 billion. That's amazing. I think it's from this one.
Doubled.
Utility and energy operating revenues. $14.9 billion from 4.8. Definitely an energy heavyweight. Their earnings also jumped from 5.7 billion to 35.7 billion dollars. Wow. But actually, Buffett did mention during his meeting that he expects moving forward to the end of this year that they're going to see weaker growth in some of their business lines. So that's a warning shot. So he's not definitely gung-ho or all positive in terms of achieving these type of gains down the road. So Berkshire, they are near their 52-week highs at $322. Their highest was $331 a share. Their price to earnings is nearly 20 times. So Toyota, it's another big company that we're going to take a look at. Financial summary, April 1, 2022 to March. So this is a Japanese company. So they just reported their whole year earnings. So we're going to just take a deep dive. So their cash is in yen, so 6.1 trillion yen. Wow, trillion. 6.1 trillion, whereas they have 11.1 trillion in short term and 15.3. So a lot of debt for the Toyota Motor Company, $26 trillion versus 6 trillion in cash. Their sales actually dipped from 37 trillion down to 31.3 trillion. They lost $6 trillion in sales, whereas their profit became better. They earned 400 billion yen more than last year at 2.8 trillion yen. So that's Toyota Motors for you. They're currently trading at 9 times earnings. Wow.
Good price then.
Yeah, since the start of the year, they're up 3%. But honestly, I would still look at their 5-year average in terms of their price to earnings, if I could pull it up. 5-year average for price to earnings, it doesn't show here. But at 9 times, it definitely looks cheap. Valuation. I still won't bet on it though. Let me see. Price return. Oh, here we go. We get the price earnings tab here. Price to book. Come on, price to earnings. That's what we need. Price to earnings gap. There we go. So for the past 5 years, they're actually trading somewhere between 10 and 14. So not a whole lot of movement. For 2022, they're actually stuck between 10 and 12. So definitely the Wall Street doesn't quite much appreciate Toyota. I'm pretty sure I know who they appreciate very much. It will be Tesla. For vehicle, yeah, for vehicle sector. And I think this is the last company that we're gonna take a look at. It's Airbnb. Since the start of the year, they're up 30.9%. They're trading at 32 times earnings. So what's up with this one? They actually didn't meet expectations, looks like. They're down 10% in the past week. So we're just gonna briefly take a look at their results. They beat their earnings estimates and sees 2023 revenue in line. I think what kind of sent the stock price down is their projections, their outlook. So they're seeing revenues between 2.35 to 2.45, whereas Wall Street consensus was 2.42. They expect their year-on-year growth in nights and experiences to be lower this quarter than its revenue growth in the first quarter. So that's why its stock price went down quite a bit. So I guess we're gonna conclude for now on that part. Well, while we really appreciate you coming on, despite the hefty schedule that we have had today in the last
It's
minute
been busy. Mhm.
warning. So I guess
Definitely, healthcare is still a good business to be in.
yes, despite the AI threat, the ongoing AI threat, right, Wawi? I heard
That's a long ways off.
a lot of journalists are also tweeting and sharing their concerns about AI replacing them, but healthcare, especially us prime movers, we try to get the patient out of bed on day one after surgery. I think not one intelligence out there artificially made can replace that. For those
Not
who
yet.
are,
They can't replace these hands yet as a manual therapist.
yeah, or those who are working hard out there, like Wowie here, who just came out of work and joined us in this podcast episode. We thank you guys for your hard work. I guess that does it for today's episode. I guess we're ready for making our dinner at this point in time. Um,
Yes.
thank you again, Wowie, and again,
Thank
this
you
is
too,
Mark
Mark.
Q signing out.
Signing out.